Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions. It's that time of year when we like to review all of our stock decisions to see what we messed up on. And trust me, we have some doozies this year. Wait until you hear these numbers. There are two reasons we do this. One, it keeps us from becoming arrogant little buttholes. Staying humble keeps you from making huge mistakes and losing it all. Number two, it forces us to learn things we might not have been able to otherwise. The more you know about something, the more you realize how much you still need to improve. And with investing, things are always changing, so we need to continue to make sure that our process is locked down to reach and keep our goals. Sharing these screw-ups lets you know we're no different than you. Beating yourself up over mistakes just causes anxiety, and laughter is the best medicine. So now let's cover the 9 whoopsie daisies that left us reeling this year so you can laugh with us, or at us, or both.
Okay, if we sound bad, it's because we both got the vid.
Mainly Tim.
So that's a.
So he might be a little extra grumpy today.
That's
even though
thing.
this is a fun topic, I think, although it might be a little painful for you.
That's a thing that we got for Christmas. Apparently, the family got together, and that's what they gave to everybody. So,
Merry Christmas, people.
Merry Christmas. And I have the Grinch hat on because that's me. If you recall, we are going to be talking about the 2024 whoopsie-daisies. There's a couple. For the most part, though, 2024 was pretty good. I mean, I lost a little bit of money here and there, but like most of the whoopsie-daisies are actually I sold too early. But we'll get into it.
Yeah, that's always fun. And that's one of the huge reasons, and I will say this yet again, that growth stocks are super hard for us. And I'm pretty sure anybody who's done different kinds of investing has very similar issues. Because it's like I don't even think it's greed all the time. I mean, sometimes it's like the euphoria, you get wrapped up in the whole thing. But like for us and for Tim, using the metrics, it like doesn't make sense, right? Like it doesn't jive with what you're seeing from the data perspective.
I like to take profits when I can. And
I mean, that's a good rule of thumb.
Sometimes I take profits too early, and sometimes I don't.
Yeah, some people tell you to sell incrementally as you go up, as opposed to going all out. But
this is like my favorite podcast and email of the year is the one where I address
everything you screwed up,
what I did wrong. Like I call it my stellar calls.
But what's cool about it is like you can analyze the situations and then figure out what the heck actually might have happened so that you can improve going forwards. Because the whole goal of like your failures is to like try to improve going forward. It's okay to fail, but it's not okay to fail on the exact same thing over and over and over again because you're not learning a lesson. So failures are fine.
I like them. They're good for learning.
They're also hilarious if you can look back and laugh at
if you can laugh at yourself. I can laugh at myself. I have that gift that a lot of people don't.
Yeah.
And as I say, if you can't laugh at yourself, you suck. So
I am also one of the depreciating humor.
So, but yeah, we did some bangers this year. The first one was Zero Fox. I don't even know if it has a ticker anymore. I literally
didn't even know this thing existed. Tim does a lot of these trades. Like these are growth stocks mainly, not all of them.
Most of these were in the IRA, the retirement, the tax recount.
So we have a very small portion of funds I have a Roth open, and I think I had Tim open a Roth. And the whole point of doing the Roth is to, if you do hit like the next Amazon type deal, you're basically never going to get taxed on any of those gains. So it's like a super huge win.
So we do have, like, for example, Planeteers in both of our Roth accounts.
Yeah.
And I got Planeteer at like $12 in my Roth. So it's like...
What's it at now?
82 or 79 or something like that. I think it was at like almost 85, and then it dropped a little bit on Friday. So it's up a lot. It's like up hundreds of percent. So
that's pretty sweet.
But Zero Fox was a cybersecurity company. And I was really big on the cybersecurity at the beginning of the year. And I think that's going to be a niche to look at going forward because we're going to have all this data from AI and that you're going to need companies to secure it so people's personal information is not being spread or stolen or whatever. I looked at the chart on this one, and in 2022, it was around $10. And then it dropped in 2023 like everything else did in 2023, like in August. And then it bottomed out. So I picked it up thinking, okay, I'll hold this one for a couple of years. It'll get back up to $10. The problem was someone else, this company called Havalai, they had the same thought process I did, and they bought it up. So like it became a private company in the beginning part of 2024, and I was only able to go from 90. I bought it for 91 cents in January, and a mandatory sell of $1.14, because when it went private, it said we'll give you $1.14 per share. So,
do you know what the ticker of that is? Will it still come up even if it's not a thing anymore?
It might. I don't know.
Cool.
So my plan was to ride that all the way back up to $10, and it got derailed by a private acquisition. So that, it's not a huge whoopsie daisy, because we still made
that's a profit,
20%, but it could have made like thousands of percent.
Yeah, it's not even coming up in Yahoo Finance anymore. So
that was the first of a few errors that I came across in 2024.
Errors. So what did you learn from that? Are you going to do that at the end?
I didn't learn anything from that. Just like
so there were no red flags, like nothing you could have predicted, anything.
I think what a lot of times happens whenever you buy, like they're called penny stocks if they're under 5, as you're aware of. If you buy a penny stock, there's always the possibility that it'll go to zero. Mm-hmm. And there's always the possibility that it will pop off for like hundreds of percent gains. And then there's a third possibility that it'll be bought up by a company. Yep. So that's just part of
penny stocks,
dabbling in that area of the market. So would I change anything? No. Not really.
So it's just like a probability and odds game?
Yeah. I believe that cybersecurity is a huge portion of the market that needs to be invested in for potential gains. And so I found a company that was undervalued by like 900%. But
so I'm curious to know your thoughts on this. One of the big reasons that I really like crypto and like the tech underlying crypto is because it should actually get rid of the need for the individual security companies. So I wonder if that may be why Zero Fox's like niche needed to be incorporated or bought up by somebody who had like a better vision of like integrating crypto and like cybersecurity.
Possibly. I don't know.
Okay.
They didn't specify.
Tim's not functional right now.
They didn't specify why they bought it out. So
okay.
So that's that one. That one was bad, but the next one was super, super duper bad. Ticker is NBY.
I'm going to pop this up.
It's a pharmaceutical company that
Nova Bay Pharma.
I thought would be really well, and I'm just going to end up holding it.
What frame?
I bought it at $6.08. I think probably this is going to be a 10-year. You look over here, you see how well it was doing.
Do you want your pen?
And then I got it at like $6 when it was way down here. But this is like hundreds, like thousands of dollars. Was that $1,000?
Is it?
Wow. So yeah, I got it down here at $6 and it fell off the face of the earth.
Well, that's a 5-year chart. If that was literally trading that hard before, wow. What happened to that?
As a pharmaceutical company, if you have like stuff in the pipeline that doesn't pan out, you get punished really bad. And like
really hard.
It had a couple things that it had in the pipeline that it was going to do clinical trials for, and the clinical trials either were canceled or they were negative or failures. And when that happens with the pharmaceutical company, they shoot down a lot. Like it's the same side of the coin though, is if the the trials in a pharmaceutical company show significant, statistically significant results, they will pop up like hundreds of percent. So this company research, manufactures, and sells products for eye care and wound care. So like, I thought wound care because there's so much war in the world. And eye care because everybody's eyes are getting worse and worse and worse.
My Coke bottles.
So that seems like a good area to have a pharma company in, but
apparently not.
Like I said, it had a clinical trial that came up poor. But the ironic part, if you will, is like the Q4 earnings in 2023 showed a 60. Okay. Why I bought it. Q4 earnings in 2023 showed a 67% growth year over year in sales. Plus, they signed a new contract with Avnova, and I was like, "Oh, okay." So they have good earnings, and they just signed a new contract. But then the earnings in Q1 were negative $46 a share. Q2 was a negative $1.37 a share, and Q3 was negative 33 cents a share, and then in Q4 of 2024 it was negative 11 cents a share. However, if you were thinking about taking a couple $100 flyer on something, I think this is one now that's based on recent revenue reports, earnings reports, momentum, and chart action, I really think this is actually one that you could probably make 100, 200% on pretty quick.
Did you sell it?
No, I still have it. I rode this one the whole way down from $6. I got it at $6.08, and it's currently at 58 cents. So I rode this the whole way down. But I do believe that this one will be one to look at if you want to invest in a penny stock.
Well, I would also say that I think pharma stocks in general are really hard unless they're like established big ones like Pfizer and Bristol Myers Squibb.
They're very volatile.
Very volatile. Kind of like crypto. The problem with those is, like, again, it's all based on the clinical trials.
So that was a huge what the hell was I thinking moment, because that dropped.
Had I known about this, I would have definitely questioned it.
Like 80-some%. So, but good news is it can't go much lower. And
True.
I only have $200, $300 in it, but it's still a really bad one. I bought it on 115. So the third whoopsie daisy in the retirement portfolio for her mom, we bought April 16th. We bought UHT, which is a healthcare REIT. We bought it for $33.85. Now, healthcare REITs, if you've read the email and listened to the predictions for 2025 and beyond, healthcare REITs are going to be huge going forward because the boomers need medicine and places to live and whatnot. So we got over here because I saw, it's going down. So I bought it like right before it bottomed out. And then it started going up. I was like, oh, nice.
I'm such a smarty pants.
I'm so awesome, right? So I got all this gain right here. And I was like, oh, it's tapped out. I mean, it went up like 8% gain. I bought it for $33.85. I sold it for $36.53. I got 8% gain. And I thought, oh, this not going to be able to go. That's a lot of gain for a pretty popular company right away. So I said, this won't go up any further. And as you can see, I f***ed up because it went up a whole hell of a lot more. I missed all this. Now, granted, it's turned around and it's like lower than what I sold it for, but I missed all this gain here just by premature selling. What that came out to be is I actually missed out on 32% more gains because it peaked at 47.30. So it peaked at 47.30, which was 32% extra gain. And I don't know why it went down. Like, I really don't, unless, I mean... That
was what I was going to ask. Do you have any idea why? What happened? Bad news?
Bad earnings or something like that, but it went down a lot. This one is a dividend, I think...
Champion?
Achiever, 20-some years of dividend growth. Mm. And it's going to be quite good for the future because, like I said, old people getting older, it's going to, more people in homes is going to drive up more revenue. And I can foresee this one actually getting back, testing this $100 range that was over here. So that's what my initial plan was, but then it went up so quick, so fast. I was like, oh, I learned from previous experiences that when it goes up like 10% within like a couple of weeks, you probably want to get out. But then I messed up because it obviously just
kept going
forever.
But this is what we keep saying. Like,
yeah.
We are not very good at, I don't really do a lot of the trading or like the growth stock stuff. But Tim is just, it's so hard to predict the investor sentiment because it's all over the place.
Yeah, I missed out. That's a lot of gain right there. That's bad. That's not even...
Yeah, but how much money did you actually put in this? Not very much.
A couple thousand.
Oh, you did put a couple thousand.
Yeah.
All right,
I was actually going to, in your mom's retirement account, I was actually going to replace the medical properties with UHT because UHT had better financials. So I put money into it, and I was like, ooh, I made a lot of money. So I'll sell it, and then I missed out on this.
So which one's better? Like, which one did you end up making more on? Because I know medical properties dropped its face off, too.
Oh, this one I made money on. This one was MPW.
We lost money?
Lost a lot of money on. But yeah, I would like, this one here is probably one to look for in, I mean, this chart here is kind of troublesome. So like, if you can determine when it's going to bottom out, I think this one's good for the future.
Although I do think we should caveat, we mentioned in last week's episode that the Santa Claus rally, Tim was not bullish like usually everybody else is. I keep
getting emails about how the Santa Claus rally is in full effect and you should invest to get more to partake in the Santa Claus rally, but I don't.
They're smoking crack. They're literally manipulating the the standard definition of what the Santa Claus rally actually is to make it look like it's going up or they're predicting something, but the Santa Claus rally doesn't actually end until, what did you say, the second trading day in January?
Second trading day of January and the last 5 trading days of December.
So they don't even we're not even at the end of the trading day thing or the trading week for them to even lock in their fucking values.
But it's gone down. Like, I think if you look over here, you see the markets drop their faces off.
Yeah, they've been really, really down. And we think that is because there was such a rally after Trump's, like, was deemed the president.
Well, like, there was a lot of investor positive sentiment after Trump was elected, but then people are actually starting to look at the potential policies that are going to come into effect, and they're like, oh, maybe that's not a good thing. So there is, like, where's the S&P chart?
SPY?
Yeah. This is not boding well for a continued rally. This, to me, says it's probably going to end up down here somewhere before it turns around. But the whole year has been ridiculously good. But the last part, like, this is the Santa Claus rally here this day.
That's not a rally. That's like fell off a cliff, so we're trying to climb back out of the hole type deal.
Yeah, so
that's what that looks like to me.
But I'm not bullish on the next, like, 7 to 15 trading days. I think it's going to be lots of volatility and lots of
tax loss harvesting,
lots of down days with some occasional up days, but that's that. So I messed up on UHT. I missed out on 32% of additional profits. I probably would have got 25% and I would have sold out. So I missed out. Realistically, it's very difficult to sell at the top.
Oh, very hard. So
I probably would have sold like around here somewhere. So I missed out on like 25% gain because I would have sold around here and it would have popped up and I'd been like, God, I suck. But I did miss all this nonsense. So that's positive. Okay. That's number 3. Number 4 is ARKY. I am not a big Cathie Woods fan. And if you're not familiar, the ARK stuff, this ARK, she is like the main person that deals with all the ARK ETFs and ARK investing. I'm not a big Cathie Wood fan. I do follow her though because there's so many people that follow her investing strategy that you can get a view of how the general public is going to invest, so you can get ideas like.
So you actually use her as kind of like the market indicator for the general populace? I don't
use her like I do Jim Cramer. When Jim Cramer says anything, I do the exact opposite.
Exact opposite,
but
right?
Cathie Woods sometimes has good ideas. Like, she's been high on Bitcoin forever, so she does have like redeeming qualities. But like, her investing is kind of caca. And I think they did a thing in 2023, like basically trying to calculate her returns, and like, she's not real good. She doesn't have a real successful track record.
She's not real good.
But I bought this in 112. I bought this like pretty much one of the first things I did in the new year is I bought this right here. This tip.
Wow.
This tip. So I bought it at 32.40 and I held it all the way through May 7th.
That's a pretty good little climb.
So May 7th, I sold it at 37.75. So I made 17%.
That's about where it's at right now.
But the problem here was I held it through the peak.
Yeah.
So it peaked over here at like 49 about, and I held it through the peak and I held it through all this down here. And then I was
But again, look at that up. Like, how could you guess that like level of up would just keep going up?
So I said, oh, it's consolidating. But like, the reason I sold it, you see it was consolidating, but it was doing the lower highs, lower lows type of consolidation. I was like, oh, this isn't good. So I'm going to get out while I still have a profit. I mean, so I did miss this up here. But this is like, if you remember, Bitcoin halved like right here. That was the Bitcoin halving April 24th. So this was all the euphoria going into the Bitcoin halving.
Yeah, okay.
Because you see,
kind of like Trump's presidency. He got elected, and there was that massive thing of euphoria that we had, and then like.
And then you look right here, Trump got elected, and then cryptocurrencies all took off, but now they're starting to consolidate with lower highs, lower lows. So I think crypto's going to go down a little bit before it goes back up in 2025. So we missed all this down. But I missed this up here, and I missed this up here by selling right here. So that was a bad thing. I missed potentially about 34% more gains. And again, realistically, it would have been about 20 to 25% where I said, okay, I have enough. I still am a big believer in this
Bitcoin
Ethereum strategy, but I think there are better ETFs out there that aren't ran by Cathie Wood.
And isn't there a yield max for ARK? I think there is, right?
There's a YBit, which is Bitcoin, and then there's a ETHE, which is an Ethereum ETF.
I'm not talking about like a crypto one. I'm talking like there's an actual Cathie Woods Yomax, right? I think it's based on ARK.
Yeah, they have a Cathie Wood Yomax.
We don't get in it.
I have never been in it.
But I just wanted to FYI that one.
Never considered getting into it. Because
when you could get actual Bitcoin.
She didn't sell here. She kept adding position to this. So like she did well up to here, and then she kept adding position every dip. You like buy the dip crap that people always say. Well, there comes a point when that's not good strategy. Because let's be real here, most people, if they were, I rode it up to this and I'm buying the dips, at some point they're going to be like, oh my God, this just keeps going down and down and down. So they probably will sell like in this area
and
right here.
And that's when it takes off every time.
And so they sell. So they rode this. So they wasted more money by buying the dip, reinvesting on their dividends, or every time there's a dip, they put more money into it. And then they freak out like right here. This is that psychology of investing.
Yeah. And
they missed this up here. But had they done nothing, they actually would have been up over here without reinvesting and buying the dips. So there is some logic to the buying the dip thing, but that's only like if it's if
you don't have the emotional thing dialed in, I would not do that.
Personally, I'd say like if it's a dividend grower, like say Verizon or Chevron or Coke or something like that, buying the dips makes sense because you're going to make more money in the long run. Now, I do see this actually shattering this. In 2025, it's going to go well above this 49. It's going to be probably in the $60-some range. So, like, you could pick up. So I believe this is going to keep going down. It's probably going to go down to 30.
Are you getting back in it?
33. No.
That's all you have to say.
$33 range, but then it's probably going to shoot up to the $60 to $70 range, so you could actually double your money if you wanted to in this one. But I messed up in this one by selling too late. Like the last one I sold too early, this one I sold too late, and I missed all of this here. So this was a bad time. I suck. Next one.
I suck.
Next one is CRSH. I'm not too upset about this, whoopsie daisy, because this literally is a experiment I'm running with YieldMax. YieldMax, if you're aware, they have a Tesla one, TSLY, which is a Tesla long. Or YieldMax has a Tesla long, TSLY, which is a long, and then they have a short, which is the CRSH. So I bought equal money. I put equal money into the TSLY, and I put equal money into the CRSH. The problem with this one is I bought this here at 10.18. So right at this peak here, right before the election when Trump and Elon Musk, his BFF, got together.
And decided crypto was going to be amazing for 2025.
And if you look, like you see what this has done since I bought it. It literally has just to bed. If you go into TSLY, and we'll pull the same chart up, you'll see what happened. Again, October 18th, around here.
Around there. It's like the exact
bottomed
inverse.
Out and it just shot up.
Exact inverse.
This is just the TSLY. This isn't even the Tesla one. But so when this goes up, CRSH is going to go down. So when this is going down, CRSH should go up. That's why I got that. I want to see. My theory that I posited is if you held equal money in TSLY and equal money in CRSH,
which is the short,
you could cancel out the gains and losses and just collect the dividend. And for the most part, it's been okay. I mean, I'll go into the details of.
I think we should have it for a full year at some point just to have the full data. But as of right now, it seems to be pretty. The theory seems to be pretty solid.
As of right now, we have TSLY. We're up 192 in TSLY, and we're down 286 in CRSH. So we're down about $100 total, but we've collected $127 in dividends. So in theory, holding both and just collecting the dividends is actually working.
It's like double dipping without moving your money.
But it's only like a 15% gain. So I have to this is one that I'm going to be following because there are two other potential.
Coney, right?
The Coney has the Fiat, which is the Coinbase short in YieldMax, and there's the NVIDIA dips, DIPS in YieldMax. So they actually have the long and short, both of NVIDIA and the long and short of Coinbase. Coney, I'm not going to buy the Fiat until after crypto does what it does in 2025, and then I'll probably put just as much money as I have in Coney into fiat and do the same thing. I'll have plenty of time between now and then when that happens to monitor this more with the TSLY and the CRSH. If it keeps doing what it's doing, I will totally do that. And then the NVIDIA short I'll probably look at in 2027 when the AI bubble is starting to crack. Maybe 2026, depending on what goes on with that. But so this was just an experiment to see for those other two where I think I can make a lot more money because their dividends are way better than TSLY and CRSH. But CRSH, I literally lost money. It literally went straight down from here.
Oh, I was going to say, if you guys didn't if that went over your heads, we'll explain it more later. But it's basically to keep the value of your portfolio basically even because the downs and the ups will cancel. But you'll actually be getting payments from both sides, which is actually pretty ingenious. High five, Tim. Another freaking ridiculous innovation move.
So that's number 5, CRSH. Number 6 of Whoopsie Daisies is NEM, Newmont Newmont Corporation, gold mining. Yeah. So this, this one, I messed up pretty bad on this one as well.
Do tell.
Okay, on 222 there, I bought this. You see the 222s right here. So right before it cracked down here, which isn't a big deal. But I bought it on 222 for $31.07.
You will notice a pattern. Tim's pretty good at getting it pretty close to the bottom. It's just the outs at the ups.
Then I sold it on 528.
Another example.
So I sold it right here.
Yeah.
At 41.46. So I made 33%.
That's really good.
But if you notice, I missed all this this run up again. And it peaked right over here at $59 range. So I missed out on 56% more potential profit. And then again, it crapped out. There's a theme here. Everything that I got out of ran up, but then it crapped out. But this is a bad one. And the reason why I sold it, I literally have let me read my notes. Hold on.
Let me read my notes. I'm not entirely sure why I did that.
I thought it was tapped out after its 33% gain. There was nothing in the quarter 1 and quarter 2 earnings that would suggest there was more room to run. Profit margins were down. The revenue was up, but very slightly. The debt was down very slightly, and their actual free cash flow was reducing. But then everybody got all gold happy, and it was just, this literally had nothing to do with funding. All this has to do with the euphoria people have with gold. Because the fundamentals haven't changed. Their revenue still sucks. Their profit margins still suck. The free cash flow is still falling.
Well, honestly, I don't know that I'd be super upset about missing out if you're sticking to the metrics because you cannot predict investor erraticness. And that's just one of those things.
The ironic part here is, so there was earnings, the best earnings of 2024 for Newmont.
And it crashed.
Were a prelude to this.
That's hilarious.
So,
what is wrong with people? This is why we stopped doing the trading based on the earnings reports or trying to predict before, because that makes no sense. That should have gone up from there, but it was already obviously.
So this actually is a buy, based on their earnings and everything. So the earnings here sucked. Earnings here sucked. Earnings here sucked. Earnings here were really good, but then So my question, though, is do you think gold is actually going to be a positive trend in the near future? I don't think it's going to be compared to other sectors like Bitcoin, crypto type deal. So it's one of those things where I think gold will max out at 3,000 in the next couple of years. It's currently at 2,700, 26 something. So
it doesn't really have that much room to run compared to some like the AI sector, the tech sector.
And I think the reason that it's as popular as it is because we have a lot of people that
are still
brainwashed or in that mentality that gold is
the end all be
how
all.
you hold your value during high inflation and high debt and everything. But I think that the younger people are starting to see that Bitcoin is actually the same thing as gold,
and it's so much less cumbersome
without the hassle.
Yep.
So there is a huge conflicting things butting heads right now. You have the boomers saying gold, silver, and you have millennials saying Bitcoin, Ethereum, and they're butting heads. And as more boomers exit the market, whether it's by death or retirement or whatever, the Bitcoin, Ethereum is actually going to overtake the gold and silver.
Yeah, because I imagine the demand for gold is going to go down.
So at some point in the next couple of years, you're going to see a lot of the boomers start to exit the market, and then the market's going to be dictated by the younger generation. The younger generation is
very tech
AI and Bitcoin,
crypto.
Ethereum.
Yep. Definitely.
So I think gold maybe hits 3,000 and then it'll like consolidate in a downward motion. Whereas I think Bitcoin's going to hit.
They're saying anywhere between 150,000 to a million in this next run. Like, it's crazy. Crazy.
Bitcoin could hit 250 before it does the same thing gold does. 250,000.
It's crazy.
I don't know. That's why we kind of like we have a little bit in gold and silver in her crypto
retirement account.
IRA.
Don't ask. It's a really odd thing that's available there, but
and we have a little bit of gold and silver in her mother's retirement, but we probably have 30 to 40% more Bitcoin than gold.
Lilith.
That's just reading a macro trend. Like we discussed the macro trends multiple times. The macro trend here is, okay, gold still has a potential to be a good store of value, but that's only until the people that see it as a store of value are in the market. Once they exit the market, you have to pivot to what the new people think is a store of value.
Well, that's what I was going to say. So if this is like a growth stock or a long-term hold type deal, that would only really work if the macroeconomic and what Tim is saying with the old people exiting the market, like that actually is more of a red flag. So this isn't one, even though this dip is quote unquote the buy, I wouldn't get into this.
This is a buy. This is a buy for 12 to 18.
You believe in gold?
18 months. I do for like up until about 20.
Are you getting back in it?
If it goes down to say like 1900, I might consider.
Because we do have a capital issue.
1900, but like there's
too many opportunities going around.
The problem that most people that want to get into Bitcoin are actually dealing with right now is Bitcoin's at 100,000 and gold's at like 2,600. So it's easier to get into gold.
True that.
But there's going to come a point when people are going to say, "Oh, Bitcoin's at 170,000, but I know it's going to go up to like $1 million, so that's a
no-brainer
8x or something like that." So I'm willing
$300 from a 2,700.
And there's a few articles out there. Even if you only have a 0.01 or 0.02 of Bitcoin, that's still going to be enough for your portfolio. So that's just something to look at down the road. It's coming. It's coming quicker than I think people anticipated, where Bitcoin actually replaces gold in a lot of people's portfolios.
Yeah, especially with Trump coming into presidency. He basically wants to have a Bitcoin reserve.
Okay, so number 7 is the same old.
Same old.
The ones we discuss all the time. Camping World, CWH, Icon, IEP.
Hey, let's look at this. Which one are you going first?
Medical Property. I do Camping World, CWH.
Okay.
We've held this one throughout the whole year.
Should I do more than the 1 year?
Just do 5 year.
I was going to say, because this one we could talk. We've had this for a while.
We got in.
It's the gift that keeps giving.
Got in Camping World over here somewhere. Mm-hmm. And then there was earnings here that saying, "Hey, we're buying more. We're buying more
everything as much as possible. We've converted to a growth stock, and we're cutting the dividend to 80%."
So, like, we got it right about here, and ever since then, it's literally gone down. And I mean, you see that it's consolidating, but it's still consolidating in a downward trajectory.
I don't know. That doesn't have lower lows like towards the more recent stuff.
Well, it's starting to tighten over here, so that's good.
Yeah.
But you see,
hoping that's going to be
this downward trajectory. But this one here is just one that we've been in. And I think if I didn't believe in the company and what the company does, I would have exited this a long time ago.
Yeah.
But if you look at their yield's only 2%. So this isn't even like at this point, this is no longer a income stock. This is literally just a growth stock because again, old people are getting older, and what old people want to do, why they still have the chance, is to travel. And if they travel, they're going to rent RVs, buy RVs, whatever. So this one, I think, at some point,
it should at least hit back up to where
we'll
it was.
Pass this.
Yeah,
and I do believe I see the potential for this to be like a $100 stock at some point. So, but this one just keeps on giving. Look at that, just keeps on. We got it. Remember, we got it here. So this is a But this is a prime example of like when you have a growth stock and it is bouncing. Whoopsie daisy.
It is bouncing back and forth in those tiny windows. You're never actually gaining any more value. You're never gaining any more value if it's just sitting in a band. Whereas if you were getting a dividend, you would literally be making money during that whole transition.
So with dividends reinvested, we're still down about 20% Camping World. So this one's just been what it has been.
Although that number is not terrible compared to the next two.
Medical Properties.
MP Dubs.
Is the second one of the 3 that we've held forever. We got medical.
Well, that chart doesn't look that bad.
We got Medical Properties over here in the it was like a little bit under 10. So maybe right here's where we got it.
Tim thought it would rebound.
Well, I thought, you look at all this.
Yeah, I know.
Look at all this, but it just kept going down. Now it's starting to consolidate in the area here again, but it's still
and
not
they did fix their tenant problems that they were having. So I think they finally got their issues under control.
Yeah, the tenant that was giving them problems, they basically got rid of them, and they've either sold those hospitals to a private company, or they've sold it to, or they rented it to another person. So they made a lot of sales on some hospitals to improve their balance sheet, and they've started renting out the properties that caused them to lose money out to other hospitals, businesses. What the hell are they?
I don't know.
Conglomerates. So this one's gonna shoot up at some point. This is another one that I'm pretty much confident, because you see the more, like, the reason why we stay in this one is they make too much money.
A lot. Like a lot.
That's like 800 million. That's 1.5 billion. That's 1.5 billion. That's 1.2 billion.
So those are the end of the years. That's a lot.
They make a lot of money to be trading at $3 a share.
Yeah.
Their problem is, see how this turned around, or not turned around. This actually got a lot worse. That's their EPS, earnings per share.
How'd it get worse if it...
This is 20...
Oh, it went backwards negative again?
Yeah, this is 20.
Or went down?
So it was looking pretty good. So that's why we got into it. I was like, everything's pointing towards a recovery, and then it just like fell off a cliff. But
yeah.
So this
dang tenants.
This one here is going to be probably a 5-year hold, maybe. See, the debt actually is really high still. The hell is that? That's 10 billion.
But aren't they a company that manages debt, or they take on tenants and stuff?
They take on tenants, so like this
that's
is
part
like,
of their business.
If you look at that's 10 billion in debt versus their revenue was like 1 billion, so they're down, like they have a 90%.
Yeah, that's kind
debt overhang that's killing them right now. But that should turn around. It should be more like in the next year or two. It should be like in the 8 to 8.5
to 10.
But yeah, this is one that we've like really just sucked it.
But their dividend was still pretty high and paying fairly good, so we kind of just have wrote it down.
You see the dividend's still pretty good, 8%. Yeah.
So we've wrote it down, and eventually when this thing does turn around, like our price point is going to pop off, I assume.
Yeah.
Because we've been accumulating so many shares.
This one's not terrible. We're down 40% in medical property.
And that's with dividend reinvesting, right?
Dividend reinvesting. So this
but again, way more share accumulation because of that low price point.
Now, the next one is the one that sucks. This one here, I don't know what the hell they got going.
This one is like...
This is the one that we actually sold. We sold in her mom's retirement, and we sold half of our position in it. It looked like, I mean...
think you need to go to the 5, yeah.
Like it just was
Look at that.
It was doing pretty good here.
Looked great. Looked absolutely great.
We got it back here. We've held this one since 2021. We got it in this area here where it went down a little bit. I was like, oh, sweet, dip. I bought the dip. But then the dip started getting lower and lower, and then bam.
That's a pretty... Look at that cliff drop. Look at that volume spike in that cliff drop.
This year, if you remember, there was a short seller said, hey, this company... And the company's like, no, we're good. Apparently they weren't.
Well, they were. It actually got thrown out in court, didn't it? Although he did expose a couple things that were a little sketchy. Yeah, like the fact that Icon was shorting a bull market. Like, what are you doing?
See the yield here is still really good, 22%. But the stock price is just wow.
So if we didn't have any back history in this, we would be buying this up left and right.
I would be now.
Yeah.
Because the revenue, like, again, it makes too much money to be trading that low.
Like, that's a lot. 11 point, what is this, millions?
So that's 10.2 billion so far this year. That was 11.8 billion that year.
Cray pants. That's a lot of freaking money.
The problem with them is that they suck. Like, I don't know what they're doing. Because, like, you look, the total debt's not that bad. They make more than they have in debt. The net debt's not terrible.
I wonder if Carl Icahn is grooming his replacement, and his replacement doesn't have the same vision.
Cash flow's not terrible. Cash flow's not great, but it's not terrible. But like,
or if there's a potential that he's getting senile in his older age.
If you remember, the reason that I finally said, "All right, I've had enough of this," was because they said we're going to cut the dividend again, which I said that numerous times. They're going to cut. They're going to cut the dividend in half again to 50 cents. So I fully expected the dividend cut. It was so they could buy up more shares of another company that was in a bad situation where they actually weren't improving the quality of the Icon stock. They were just using the money that they saved from paying out a dividend to invest in another company that's It's the company they invested in, I do believe, is CVI. That's the one. So they cut their dividend so they could buy more shares in this company because they had this drop. And they said, well, that's undervalued. So we're going to use the money from the dividend that we're cutting to invest in this company. And this company, if you look at it, it's not great. It's no reason to all your people have been with the Icon for all
all
these
your
years.
investors for.
But yeah, that one, Icon, we're down, with dividends reinvested, we're down 70% in Icon.
So we have a pretty big hit. And that's the one that we decided to sell off too. It was a multifaceted thing because one, he was mad. Two, we were like, screw it. We're going to harvest a tax loss for tax purposes to offset a lot of our gains.
Yeah, we did that. But yeah, this Icon is the worst of the three. Camping World, I believe, will actually have a
Yeah, I think Camping World's going
good
to turn around.
2025 and 2026. We might actually be up in Camping World by the end of 2026. MPW is probably going to take to 2030 before we're up in that. Icon, I don't know. We could be down in this for a decade. This could be like a lost decade of that money. But it's
The lost decade.
Fortunately for us, it's only like 2,000 or 3,000, so it's not the end of the world. But there's other people that put like thousands upon thousands of dollars in that.
And this is why you don't have all your eggs in one basket. You would lose your butt. And the other reason that we had such a negative experience with Icon is because we were over allocated in Icon. Like we had way
There
too much
was a
of our
time that it was
portfolio.
like 10% of our portfolio.
Yeah. And now we have a 5% rule. So
that was my bad.
yeah. That was the whoopsie daisy from last year. But we learned our lesson with that. So like
That's the whoopsie daisy that keeps on giving. That's probably going to be on next year's whoopsie daisies, and probably going to be on the year after that whoopsie daisies. But the next two for 2024 whoopsie daisies were ginormous. Like these are serious. Wow.
yeah, serious losers.
First one is Calm. It was I remember talking about this. Calm was the egg one we were in where we made a lot of money. Made a lot of money in Calm. It did awesome for us. So awesome. But then they came out with financials, their quarter of their
Yeah, we talked about the egg one because we were like, oh, Calm's amazing. Like what freaking stock has like the lowest beta ever?
yeah, it has like no volatility. It's
There's like
awesome.
no volatility. This thing is.
So the first thing that Calm did in 2024 is they reported their quarter two earnings.
Oh my God, look at that up.
So we bought it over here and we wrote it up for all this, and then we sold it at 55-ish, 56. We sold it like right here.
What did we buy it at?
I don't have that, but I know we made a lot of money on it. I think we bought it down here.
Which is about what, $46?
40.
Then you got out like 55.
44, and we got 55. So that was like we were like, it was a really good gain. It was like
For a, like no beta stock, yeah, like a low beta.
so it was like a 25% gain. And I got out of it. I was
for
like,
something that does something super boring that literally all they do is eggs.
awesome. And then right here, the very first thing they did, you see this down right here, they reported their quarter two earnings where they said, our earnings sucked.
That was what made you get out,
We're going to
right?
cut our dividend. So they had an earnings miss on 1/3, a 58% EPS miss, and they had the revenue was really down, their cash flow was really down, and they cut their dividend to 11 cents a share. So I was like, well, that's
58% EPS cut.
So I was like, oh, that's not good.
Okay, so you stuck to the metrics. Like you literally implemented your strategy on this one. So who could have seen that it like ran?
And then
What?
then quarter three earnings, they smashed their quarter three earnings. And their quarter four earnings were over here somewhere. I don't have the earnings things on here, but they basically just smashed their earnings for quarter three and quarter four, and their quarter one. So like right here is where they have like their first quarter for 2025. They smashed it there. Revenue was up 51%. Net income was up 880%. Debt was paid down to zero, and they paid out $2.79 in dividends per share throughout the year. So the price when I sold it over here at 55, it went from 55 all the way up to, what is that, 110?
That's crazy.
I think the high of the year was 114. Yeah, 114 was the high. So I missed out on a plethora of upsies on that one.
Upsies.
So that's like an additional 44% gain plus the 279 in
my God, that's
dividends I missed
I
on.
will say I wasn't even aware that you sold this one for the longest time. So I kind of am hoping that because we weren't really like super vocal about selling this, that if anybody that's listening stayed in it, they got this gain. I'm hoping.
Yeah.
Tim's like, yeah.
That was a huge, gosh.
A huge whoopsie daisy.
Huge. And they have.
But there was nothing to indicate that, was there?
I'm saying I went from the earnings report where they cut the dividend down to 11 cents and the EPS was down, cash was down, debt was up. I was like, oh, that's not good.
So what's the dividend doing now? Is it still like cut?
Oh, it was 12 cents. My bad. Then they did $1 and then they did 77 and $1.02. But if you look at where we were at when we were collecting dividends, that was a warning sign. I was like, okay.
The 1 cent dividend?
So but then we got these dividends here.
Oh, the 221 is insane. 2.2.
So I know that it's a variable dividend, so it bounces around, but the fact it went
to a penny?
It had a penny and then it only went up to 12 cents. I was like, holy crap. So that's very bad. And like that, and both these earnings reports were not really great. So this here,
and it's quarterly too. So.
I have no idea how they turned it around.
Still don't.
No.
Interesting.
I think it's just basically because eggs went up in price with the inflation and everything.
Oh, maybe.
Because this is comparable.
Because my question, when that last report came out with that huge dividend, did you consider getting back into it?
No. At that point, it was too late.
It was too late.
This is comparable here.
3 penny and 13 cents.
So that maybe that's what it does. It'll just keep going. So this will be like $2 and then $2.50 or something like that. So this one's one to watch if you think the price of eggs is something to get in. But like this, I mean, it might be too late to even consider. Like maybe
I don't know.
Maybe
this one's
here
interesting.
You could have got into it, but like up here.
That's why I was asking, because that's where you said that third quarter where it basically turned its stuff around. But I don't know if you would have had this on your watch list still if you had moved on at that point. That was why I was kind of wondering about that.
So let's look at that. We had a 44% gain missed in Calm. We had a 56% gain missed in Newmont. We had a 34% gain missed in ARC. We had a 32% missed in UHT. So those all seem like, oh, that would be the worst. That's no.
Is this the last one? And here's the freaking
this one.
Coup de grace, man.
If you listen to the podcast for a while, you remember how I talk about Iron Mountain. I was in Iron Mountain at a time, and I made like 40 or 50% Iron Mountain, and I got out of it. I think that was on
last year's Whoopsies.
And Iron Mountain just proceeded to go from like $30 up to $100. Yeah.
That's like a 200.
Iron Mountain looks pretty good right now.
You mean not so bad?
Not so bad. Okay. Rocket Lab.
Just wait for the numbers, guys.
I bought this on 2.5, so right here after this dip, I was like, I'm going to get into it. I got it at $2.93 around. I don't know how I got it there when it says $4, but I got $2.93. I sold it on 6.18 at $5.01. I was like, oh, I got 71% on this company that has like no fundamentals. Like everything sucks about it. I was like, I'm hot. I made like almost 100% on this. Yeah.
Look at that chart. Oh my God. It took off. It took off from that $5 whatever point up to like 27.
Yeah, I missed all this.
That is freaking sane.
So that's 700% gain for those of you that want to laugh. I missed out. I actually had a stock that went up
retarded
700%.
700%.
And I sold it for a 71%. Or actually almost 780%. I sold it for a 71% gain. And there's nothing in this that would lead me to believe that any of that was possible.
This is one
Revenue,
of the reasons.
Operating income,
Is it still kind of crap now?
Yeah.
Oh.
EPS,
Did this happen to get like an Elon Musk tweet or something? Like what happened?
Well, you just have to know. No idea. You have to know what it is.
Rockets, obviously.
It's a space exploration. Yeah.
That's why I asked if Elon had made like tweets, because you know how he does that, like I'm making money. Push the money button.
1 year return of 382.
Jesus Christ.
392 year to date. Yeah, I completely pooch on this one.
Yeah, but there was really nothing to indicate that, right? But we will say that we've been in different cryptos and all sorts of stuff. And when you're not sure about stuff, it kind of is. That's why we flipped over to that policy of get your initial investment back and then let it ride just to see what happens, because you're at no risk at that point.
So at the time I bought it was a little known space company. All I knew about it was that it provided everything from launch services to rockets and everything in between, like the hardware and the software in between. It's a momentum stock because earnings are negative, revenue's low, debt is what it is.
I wonder if this is going to crash as hard as it went up.
888%. Wow. This is my worst of all time.
But you're saying none of the metrics even say that it should be where it's at, right?
The lesson to learn from this. So you
take your initial investment out and let it run.
Yep. Take your initial investment out,
That's
but
the
you have
lesson.
to know macro trends. I did
Wasn't paying attention to the rocket thing.
You see right here, like when
Trump
and Musk came around, it just like
took off,
went crazy. It like more than doubled.
But it was creeping up before that.
Macro trend of space exploration is a huge thing that I thought wasn't as big as it was. So that is how, if you remember from the 2025 predictions where I said Starlink's going to be like one of the biggest things ever. Yeah. Because this company that has crappy fundamentals with crappy finances did this. Can you imagine what Starlink, which is making $1 billion a quarter, will do?
And I was going to say, when you're in a bubble like that, like you see with the AI bubble, it was kind of like the .com bubble. Anything that had a .com literally just went up just because it was part of that like thing. NFTs went through that whole thing. Crypto kind of went through that whole thing. Like Dogecoin has zero fundamentals. That thing shot off there for like the longest time. Now there was some like Elon Musk pumping, but I think space exploration is going to be another like interesting little bubble where anything that has to do with that, even if they are crappy fundamentals, this is a prime example of what happens.
That's why
they just take off. People don't want to do the research. They're just like, nah. What are you looking at?
Yes. STM. That's what it is. So that's why we invested in this one. It has its fundamentals are better, and look at it went down. So you're like, oh, so you know what it's capable of, but it has better fundamentals than Rocket Lab did.
But I think you guys are going to be listening to this like the day before New Year's. And I believe there's like rumors in the underground that Elon Musk is going to announce the IPO for Starlink, which should make this stock pop off. ASTM. What was that other one? That one pop off.
ASTM, yeah. And
maybe even Rocket Lab pop off more. Or maybe Rocket Lab will crash because Elon Musk is launching the other thing. I have no idea.
ASTS, Space Mobile.
Yeah, that's what it is. ASTS. Okay.
So STM and ASTS. This one.
That's definitely going into a consolidation period if you look at the tail end of that.
Yeah, so like those two are the ones, like we mentioned it before, I do believe those are going to be huge. Like those are, put them in your IRA for like a couple years to see what happens.
Well, your Roth, if you're going to do Roth for that, because that way you can at least pull your initial investment out without tax penalty.
Whatever, but so don't be a Tim and have a Rocket Lab.
Yeah, don't be a Tim and have a Rocket Lab.
So if you put, say, $1,000 into this one, once you get like, say, 2,000, pull your 1,000 out and let the 1,000 do what it's going to do.
I think that depends on the time frame, and that depends on what the macro trends are currently doing. If people are still like euphoric and stupid,
it's going to be years.
No, that's what I'm saying. It's going to be a longer time frame, but you can pull out later because then you still have a lot more seed money in there.
Because Starlink IPO is going to change the world. It's just going to take a couple years to change the world.
Yep,
I agree.
I
was just reading an article about Verizon today. So Verizon, I'll probably hold on to for 2 or 3 more years because it has it's a good dividend growth. But at some point, I'm going to have to actually take the money out of Verizon because Starlink is going to make a Verizon obsolete.
What are you doing with Santa? Santa's like, bottoms up, bitches.
Yeah, so
Starlink's about the launch.
That's the whoopsies for 2020. And if like I said, 2 of them, MBY and CRSH, I'm down in, but CRSH I'm not worried about because it's an experiment, so I only put a couple $100.
Yeah,
in
that one's just for.
But the rest of them, we actually made a decent amount of money, but I sold too early. So. And
then you have the 3 disasters.
The lesson to learn is take your initial out so that you can let your winners run. So been trying to do a better job of that the last few months. And
it's the same theory that we have with the yield max. You take your initial investment out through the dividend thing and you just let that thing become a cash cow. But growth stocks are different. You get your initial investment out and then you just see where it goes from there. Anything above and beyond that's complete profit. And if it goes to 0, then you got your initial out and your risk's completely off the table. But that's how people win at the crypto game and the growth stock game and find the next Amazon. It's a numbers game. You have to invest in a whole bunch of different stuff to get one that runs and actually makes up for the losses of everything else. But that's why we prefer dividend investing, because that's a lot harder to do and it's harder to know when to get out. So we do a little bit of that just because we're in such an interesting economic climate right now. We're tech, AI, space travel, the Starlink stuff. So it's there are certain things we kind of can't pass up on, but we're not putting incredible amount of money into this stuff. It's
I know the two that
$200, $300.
The 2 we put a lot of money into are FEPI and AIPI.
Because they actually own. That's actually another way to do this.
AIPI, if you remember me saying, I still think that because I just got the dividends for that, and it actually is a lot more than FEPI.
Whoa!
So the FEPI dividend was $1.08, and the AIPI was $1.49.
Now, put that in perspective. I think FEPI's yield was 36%, or is that AIPI's?
They're both in the 30 to 40%
That's
range.
a really good yield. But the cool part about that is AIPI is in the AI sector, which means you get a whole bunch of different AI stocks. So if the fund is doing it for you, you don't have to go out and pick the individual ones yourself.
Yeah.
That's the really nice part about those.
So that one is one that I actually think everybody that is investing for income should be in for the next couple of years.
Yeah.
AIPI.
So that's how you get growth and income at the same time. You go find funds in the macro sectors, and that's let the other stuff.
And what I do is like
lottery ticket
I don't
stickers.
actually reinvest all the dividends. I'll actually pour like some of the hundreds of dollars into did we mention THTA?
Nope, not yet. We need to wrap up.
But like what I do with the cash is I invest it in bullet shares or things like bullet shares, and then when I see a growth stock potential, I'll just put a couple $100 into it. That way I'm actually not out any money because I'm actually using my dividend money to invest in flyers. If like it goes to zero, I'll only lose a couple $100, but It's not money I put into the account, so it doesn't matter.
Yep, exactly.
For the most part,
because we haven't added to our account in years at this point. It's just all dividend reinvestment.
So next week we'll discuss THTA next week. That looks pretty banging. And then we'll do I think the comfort zone.
Comfort zones.
Yeah.
We're doing comfort zones next week because that's going to be a big thing that's going to segue into goal setting. And I'm not doing it for New Year's because most people give up their New Year's resolutions by the second and third week of January. So I want people to go through the growing pain and be like, oh, you're right. Let's redo this. So I'm going to do it different than what everybody else does.
Yeah. So comfort zones.
Happy New Year. Watch for the Starlink IPO launch.
Yeah. And that's, I suck. Okay, I have to go cry myself to sleep.
I'm going to go pout in the corner.
Fetal position. I'll be back next week. See you guys.